we are all well. Today I want us to look at advanced management accounting. This is advanced management accounting, and the concept that I want us to handle today, my good students. This concept is also very important for students who are doing, of course, management accounting intermediate level, and as well as for students who are also in ATD. So the concept that I want us to handle today will also be important to those students who are doing what? Business data analytics. So today's concept covers a wide range of course, units. So when you are looking at advanced management accounting, there is an interesting concept that is always very and most commonly examined. The concept is about flexible budget. Yeah. And in our class today, we will be looking at a question which was examined in a paper of AMA, Advanced Management Accounting, December 2022, should be question number 1B. But before you go to that question, let me take you through this journey of understanding what advanced, or rather the concept of flexible budget. So you'll find that many a times when preparing our budgets, we normally tend to talk about forecasts, yeah? But what normally happens, at times, not even at times, but most of the cases, whatever that you might have budgeted might not be the same with the actual results. So that the budgeted data might not be the same with the actual results. So what do we want to do? What we want to do at this point is to make sure that at least we adjust the budgeted data to reflect our actual performance. You see, we want to adjust the budgeted data to reflect our actual performance. And how are we going to do this? We are going to do this by now preparing what you are referring to as what? Flexible budget. So simply, a flexible budget is a budget prepared to adjust the original budget to reflect our actual performance. That is what you're terming as flexible budget. And when you are talking about adjusting our budget to reflect our actual performance, there is important fact that you must be having at our fingertips. So to adjust our budget to reflect our actual performance, we have to prepare what we normally refer to as what? Flexing ratio. This flexing ratio that we need to prepare, same, you can term it as what? Adjustment factor. Adjustment factor. These are what will always be required to prepare. And my good students, this is now the king. When it comes to flexible budget, this is now the king. So to prepare our flexing ratio, we will be required to have our actual units. We are going to divide by our budgeted units. So working out this is now what will give us what you're referring to as what? Flexing ratio. It is this flexing ratio that we are going to use to adjust the budgeted data. And to adjust the budgeted data, these are the facts that will always be affected. Number one item to be affected by the flexing ratio would be talk about what we normally refer to as what? The variable costs. So variable cost will be affected by the flexing ratio. Number two item to be affected by the flexing ratio, we will be talking about what? The sales. See, so these two components will be affected by the flexing ratio. And that is to say that fixed costs will always remain constant. Fixed costs will not be affected by the flexing ratio. So at any given point in time, whenever we are adjusting our data, whenever we are adjusting our budgeted data, we know very well that fixed costs will remain constant Flexing ratio, the one that we prepare, will affect the variable components and the sales component. So that to make sure that this concept sticks well, we go to this question. Advanced Management Accounting, question which was tested in December 2022, question number 1B. I'm going to share this question with us here so that all of us can be able to view it. I believe it is very visible. I've shared with us. I've shared with us at that point. I want us to go through that question together and see what you're asked and what you're required to do. So a good examiner is telling us that we have this company known as Trans Limited. We have this company known as Trans Limited. So you're told that Trans Limited has provided the following, operating statement, which represents an attempt to compare the actual performance for the quarter, which has just ended with the budget. Yeah. So at that point, a good examiner has given us the following items, which includes, number one, we have the number of units, you have the sales, you have cost of sales, you have all these elements, including what? The net profit margin. Required, see what you asked. Using flexible budgeting approach, redraft the operating statement so as to provide a more realistic indication of the variances. Discuss two problems associated with the forecasting of figures, which are to be used in flexible budgeting. So that is what the good examiner is asking us to do. So my good students, the most important question will be, like, anytime you ask of a flexible budget, do we have of course, the concept? And that concept, of course, Molimo just shared with us right now, right? So see how this question will be easy to apply if at all we have all the details together. I want you guys to observe how this question is going to be easy having all the details together. So allow me to squeeze this question below here, because we might need it for the data. So let me squeeze it up to that point. So we've agreed that whatever that we'll be adjusting will be what? The data, the budgeted data. That is what we'll be adjusting. So right away, we have this case here. At all times, number one, I will always be required to prepare our flexible, or rather our flexing ratio. So I want us to prepare our flexing ratio. We've agreed that for us to prepare our flexing ratio, all I require would be the actual units. These are flexing ratio. For us to have a flexing ratio, all I'm going to require would be our actual units. We divide by budgeted units. These are what I require. So that having this case, identify what you are given. In terms of our units, how many units were we given in our case? If at all you can check, we were given the number of units sold. Actual, we had 720. And budget, we had 640. So therefore, we'll agree what will be our flexing ratio. Our flexing ratio, we will be having a value of 720. We divide by 640, which will give us a flexing ratio of 1.125. That is what Molimo is getting. Confirm, guys, if at all you're having the same values. So once we have determined this, we've said that this will be our king. Flexing ratio will be our king. So from our data, I want us to arrange it in a manner where we have our variables and fixed costs. So going to our question, we are given our sales. So we are starting with our budget here. This being our budget. We have our sales. Consider our variable costs. So looking at our variable costs, we have it here. So what will our variable cost entail? Our variable costs here will entail the following. Number one, we have direct materials. We have direct labor. We have overheads. Under that case, we can also see we have selling and distribution costs. Selling and distribution costs. We also have admin costs. These are simply our variable component. What about our fixed component? So for fixed component, talk about our fixed costs. Fixed cost, what were we given? Number one, you can see we have labor cost. Number two, we are given a component of selling and distribution cost. Selling and distribution. The other point, you are given a component of what? Admin cost. So these are the details that you're given, where it will be upon us to separate in terms of fixed and variable component. So we have our data here. So we talk of our budget. Budget, the variables given. We have, this is a 1024 budget. Sales, we have 1024. 168 materials, 240 labor, 32 overheads. Variable, you're given 144. That is selling and distribution. We have 48 variable selling and distribution. Fixed cost, in this case, a labor cost, we can see you're given 100. We have fixed selling, we're given 72. And we also have admin cost fixed, which in this case we have 184. Okay. So once we have this, we've agreed that we want to adjust our budget to reflect our actual performance. And that is where the flexible budget will come in play. So we have our flexing ratio here to give us our flexible budget. So our flexible budget would be, I multiply all our variable components with the flexing ratio, which will be determined to be 1.125, 1.125, 1.125, 1.125, 1.125, 1.125. These will only affect our variable component and sales, just as Mwalimu had mentioned earlier on. So once we have this, let us see the effect. 1024 by 1.125, that is to say, I'll be having a value of 1152 here, being our sales. 168 by 1.125, this will give us 189. 240 by 1.125, this will give us 270. 32 by 1.125, this will give us 36. 144 by 1.125, this will give us 162. 48 by 1.125, this will give us 54. So we have prepared, or we have adjusted our variable components in cells to reflect what we want. What about our fixed cost? Fixed cost will not change. Our fixed cost in this case will just remain to be the same. It will not change. It is not affected by the flexing ratio. So once we have determined that, the next step would be what? For us to determine our profit, of course. So what will be our variable cost? That should be 168 plus 240 here, plus 32 plus 144 plus 48. Of course, this should give us a value of 632. And what about our fixed cost? That is 172 plus 184 to give us 356. So that is to say, our profit in the first case I should be having the 1024 minus 632 minus 356, which would give us what? A value of 36, and confirm with what you are given at that point, which in this case, of course, we are given a value of 36. That is what we have, right? We have 36. So with a lot of confidence, this is the value that you're getting. What about for flexible budget? For flexible budget, then same procedure applies. We have 189 plus 270 plus 36, my good students, plus 162 plus 54, which in this case would give us 711, confirmed. And if at all you're having any question on the comment section, of course, if at all you're watching us via YouTube, on the comment section, you can always ask a question there. And if at all you need our classes, of course, our numbers are just as indicated below this video. See down there, if at all you want these beautiful classes for advanced management accounting, if at all you want these beautiful classes for advanced management accounting, don't hesitate to reach us out. There's always been that notion that, oh, advanced management accounting is somehow complicated. I can assure you, with these classes of ours, you don't need to worry. You don't need to worry, okay? So my fixed cost, of course, will not change. Just be the same, 356. So that as at the end of the day, what will we be having as our flexible budget? I'm having 1152 minus 711 here, minus 356, which in this case, Mwalimu is getting a value of 85. You can confirm on your end. Mwalimu is getting 85. Mwalimu is getting 85 as our profit. This is a net profit here. Net profit. So when you are determining now the variances, what we'll be doing, of course, this is a class for another session, we will be comparing our budget and actual. Because recall, what variance entails, variance is always a difference between the standard, which in this context is budget, and the actual. So we normally tend to have two forms. Favorable variance. These are where the actual results is better than the expected results. We also have, of course, adverse variance. Adverse variance is where the actual results is worse than the expected. So what will be required to do here, my good students, which I want you guys to do, is to compare with the actual data that we have given you there. So list all the actual values here, then we get the difference and determine adverse or favorable. The concept here that I needed to drive it at home was for us to understand how to go about the flexible budget. And I believe that concept is at home. So for those who are doing advanced management accounting and you want to pass this paper with only first attempt, don't hesitate to reach us out. It doesn't matter. I understand you might be like, Mwalimu, right now time has gone. No, you still have a chance. You still have a chance. Very good chance, of course. You still have a very good chance. So if at all you're having any question right now, the floor is open to us. I want you to ask on the comment section. There, Mwalimu will be here to help us. Ask as many questions as you can, and of course, Mwalimu will be here to assist us. Otherwise, at this point, of course, we have other units as well for CPA. which you can literally access them on our application, that is app.mdarasa.com. Just go to this point. You're going to get create your account. After you created your account, we have very beautiful classes for you. And what we provided in this case, it will amaze you guys. Yeah, we have that offer. And this offer, I'm not going to say it here. You just go on this app and check the offers that we have, not from our usual prices. You will be surprised. To that point, guys, I hope you enjoyed the class. See you in our next class. And I hope you've gotten the concept. Wish you all the best.